All right, buckle up, because this deep dive is taking us straight into the mind of Warren Buffett.
That's right. We're cracking open his 1977 letter to Berkshire Hathaway shareholders.
This isn't just any old letter, though.
No, it's a masterclass in contrarian thinking, disguised as an annual report.
And trust me, even decades later, it's packed with insights that are more relevant than ever.
It's like getting a glimpse into how Buffett sees the world, especially when the market was throwing everyone else for a loop back in '77.
Okay, so 1977, set the scene for us. What's going on in the market?
So picture this, right? It's a time when most investors are getting tossed around by every little market wave, chasing the next big thing.
Sounds a little too familiar.
Right. But Buffett, he's standing firm, like he's on solid ground, completely focused on the long game.
Not interested in riding those waves.
No way. He's looking for those hidden islands of opportunity that everyone else is just sailing right past.
And this letter is like his treasure map.
Exactly. And, right off the bat, he challenges this conventional idea of earnings per share. He says, forget that, focus on return on equity capital.
Sounds a little jargony, but I'm guessing there's deeper meaning there.
Oh, absolutely. It all comes down to efficiency, squeezing every ounce of value out of every dollar.
Making your money work harder.
Exactly. It's like, think about renting out a spare room versus building a whole apartment complex on that land. Same space, way more potential.
Okay, so you're maximizing what you have, not just settling for whatever comes easily.
And he uses their textile business at the time as a prime example. They're pulling in record earnings, right? But he's not celebrating, he's calling it a struggle.
Why is that?
Because he saw it as a leaky bucket. They're working hard, but they're fighting a losing battle in a tough industry. It's about recognizing where your efforts are best spent.
So where did Buffett see the real opportunities? What was he excited about?
Insurance. And not just any insurance, but the kind of insurance Berkshire was in. Think of it like a cash flow machine.
I'm intrigued. Break that down for us.
You collect premiums up front, right, but you don't pay out claims immediately. So you've got this pool of money just sitting there earning interest. That's the float.
Okay, and what does Buffett do with that float?
He treats it like fertile ground. He invests it in other businesses, in companies he believes in for the long haul.
So it becomes this self-perpetuating engine of growth.
Exactly. He's finding diamonds in the rough, polishing them up, and watching their value grow exponentially. And another key ingredient in all of this, people.
Especially in the insurance business.
It's all about trust, right? You're promising to be there for people when things go wrong, and who builds that trust? The people running the show.
So how do you find those trustworthy people? How do you spot the ones who can weather any storm?
Well, Buffett was a master at it. He mentions John Seward in the letter. Threw him into the deep end at home and auto when it was practically sinking.
That takes guts.
It does. But Buffett saw something special in him. He gave him the reins, and sure enough, Seward turned the company around. So it's not just about numbers, it's about the people behind those numbers.
Their character, their values. Okay, so we've got capital allocation, we've got spotting promising industries, we've got backing the right people. What else does he reveal about his investment strategy?
Well, this is where it gets really interesting, right? He actually lets us in on his stock picking process. And it's not what you might expect.
Because he's not looking for quick wins.
No way. Remember, he's in it for the long game. He says he picks stocks the same way he'd buy a whole business.
He's looking at the big picture, not just quarterly earnings.
Exactly. He wants to understand the business inside and out, see if it has that long-term potential. He uses Capital Cities Communications as an example in the letter.
And this isn't just about owning a majority stake, calling all the shots.
Not at all. It's about finding companies so undervalued, so full of potential, that even owning a piece of that growth is incredible.
Okay, so he's patient, he's in it for the long haul, but he's also willing to be bold, to make big bets when he sees an opportunity.
That's Buffett in a nutshell. He's like, I've done my homework, I trust my gut, and I'm not afraid to go all in.
It's that contrarian streak shining through, isn't
Yeah.
it? Going against the grain, trusting his own judgment, even when the market might disagree.
It's like everyone else is at the racetrack, betting on the flashy horse, and he's over there investing in the stable, knowing that's where the real value is built.
Oh, yeah, and it's that long-term vision that has defined his success.
It's about building a legacy, not chasing a quick buck. And he's inviting us along for the ride, sharing the principles that have guided him every step of the way.
And what's incredible is how relevant those principles still are, even in today's market. It's a testament to his understanding of human nature, of business cycles, of those timeless principles of investing.
He gets it. Markets will fluctuate, industries will change, but those core principles, those always hold true.
So as we keep digging into this letter, I'm really curious to see what else we can uncover about his thoughts on specific businesses and industries back then.
Me too. Because even though this letter is from 1977, it's packed with lessons that are as timely as ever.
Diving deeper into this 1977 letter, it's fascinating how Buffett weaves in something as, well, seemingly dry as corporate governance.
Right. It's not exactly the most thrilling topic for everyone.
But he makes it clear that it's absolutely crucial to his investment philosophy.
It's like he's saying, if you really want to understand how I invest, you gotta understand how much I care about the people and the principles guiding a company.
It's not just about the numbers, right?
No way. He knew, maybe better than anyone, that even the most promising business can go belly up with the wrong leadership or a shady culture.
And he doesn't hold back in the letter, does he? He calls out companies where it seems like management is more focused on their own bonuses than actual shareholder value.
Oh, he goes there. And remember, this is the 70s. Corporate scandals weren't exactly a new thing.
Right. It wasn't like today where it feels like there's a new headline every week.
Exactly. But Buffett was putting his foot down, saying, this is how we do things at Berkshire, and these are the standards I expect from any company I'm putting my money into.
So it's that integrity piece, right? The transparency, accountability, not just looking good on a spreadsheet.
It's about walking the walk, not just talking the talk. He believed companies have a duty to their shareholders, sure, but also their employees, customers, the whole picture.
And this wasn't just, lip service from Buffett. He actually got involved, didn't he?
Oh, yeah, big time. He'd be on the boards of companies he invested in, not just as a figurehead, but really digging into the details.
Making sure things were being run the right way.
He was a true steward of shareholder capital. That was a responsibility he took very seriously, not just a game.
And it all circles back to that contrarian approach we keep seeing.
Exactly. Going against the grain, thinking long-term, doing things differently, and not being afraid to stand out.
So we've got corporate governance as this pillar. What about this emphasis on shareholder value he talks about? How does that fit in?
Well, for Buffett, shareholder value wasn't some vague idea. It was about generating real, tangible returns for the folks who trusted him with their money.
And that meant prioritizing long-term value creation over chasing a quick buck.
Exactly. It's about making decisions that benefit the company years down the line, even if it means sacrificing some short-term gains. Again, he's playing chess, not checkers.
It's like that saying, planting a tree knowing you'll never sit in its shade. You're creating something for the future.
And that leads to one of the things I love most about Buffett, his transparency. He really wanted shareholders to understand his thinking, his rationale, even when it was unconventional.
That's why his letters are still studied today.
Absolutely. He doesn't shy away from explaining his process, even when it might go against the grain. He's like a teacher, letting you peek into his notes, showing you how he breaks it down.
So speaking of breaking things down, there's one company in particular he highlights in this letter that I've got to ask you about. Geico.
Ah, Geico. Nowadays, everyone knows them for the funny commercials in the get-go.
But back in '77, they weren't exactly laughing all the way to the bank, were they?
Not at all. They were in deep trouble, on the verge of collapsing. They'd overextended themselves and things weren't looking good.
But Buffett, being Buffett, saw an opportunity.
Classic contrarian move, right? While everyone else is running for the hills, he sees potential where others see only risk.
So what did he see in Geico?
He recognized the strength of their business model, even if their execution had faltered. Low costs, a strong brand, loyal customers. The foundation was there.
Plus, he believed in the new management team that came in to try and turn things around.
Exactly. He saw their vision, trusted their ability to execute it.
So he takes his big stake in the company, ultimately buys the whole thing.
And the rest is history. It's textbook Buffett. Going against the crowd, trusting his gut, and ultimately reaping the rewards.
And it shows that he's not just buying companies. He's buying into a vision, a potential that others might be missing.
Precisely. He's not afraid to zig when everyone else is zagging, especially when his analysis tells him he's onto something big.
Okay, so we've got Geico. But there's another company he mentions that I found really interesting, the Washington Post.
Ah, another fascinating case study. Remember, this is the late 70s. The newspaper industry is already starting to feel the heat.
And yet, Buffett sees something worth investing in.
Because he recognized the power of that brand, that reputation for quality journalism. Plus, their position in Washington, D.C. was rock solid.
You can't ignore that kind of influence and reach.
Exactly. But it wasn't just the brand. He also respected the heck out of Katharine Graham, their leader.
A true trailblazer. especially for women in media at that time.
And Buffett recognized her strength, her vision. He was willing to bet on her ability to navigate the changing landscape of the news business.
And that trust, that faith in the right leadership, is something we keep seeing as a common thread in his investments.
Absolutely. He knew even the best business in the world needs a captain who can steer the ship through rough waters.
And once again, his patience pays off. The Washington Post not only survived, but thrived.
It's a perfect example of how he operates. Identifies companies with solid fundamentals, great leadership, even if they're facing headwinds.
He's not afraid to be a bit countercultural, to trust his own analysis over the chatter of the market.
Exactly. And that brings us to another major theme in this letter, the importance of thinking for yourself.
Not just following the herd.
He famously said, "Be fearful when others are greedy, and greedy when others are fearful."
Easier said than done, though, right? When everyone around you is making money hand over fist, it's hard to sit on the sidelines.
It takes discipline, a whole lot of it. But that's where Buffett's contrarian mindset really shines. He trusts his judgment, even when it means going against the flow.
And he's not shy about encouraging others to do the same, to do their homework, their own research, and not just blindly follow the crowd.
He knew the market isn't always rational. Sometimes the best opportunities come when everyone else is panicking.
It's about tuning out the noise, cutting through the hype, and focusing on the fundamentals.
Exactly, because even when it feels like the sky is falling, those fundamentals, those are what matter in the long run.
It's amazing how much of what he wrote back then still rings true today.
It's uncanny, isn't it? Like he had some secret insight into how the world works.
Well, maybe not a crystal ball, but he definitely had a deep understanding of human nature, business cycles, the things that truly drive value over the long term.
He knew markets go up, they go down, industries change, companies face challenges. But he also knew the best of the best, those built on a strong foundation, with great leaders, those would find a way to thrive.
And as we move into the final stretch of this letter, I'm excited to see how he ties all these threads together.
Me too, because even though it's from 1977, this letter is full of wisdom that's timeless.
It's funny, as we've been dissecting this letter, I realized we haven't really talked about Berkshire Hathaway itself.
Yeah, you're right. We've been so caught up in his broader insights.
But he does address it, and he actually gets pretty candid about Berkshire's somewhat unusual structure.
Oh, absolutely. He knows it's not your typical conglomerate. He even pokes fun at how Wall Street must look at this mix of businesses and scratch their heads.
It's like he's saying, yeah, we've got insurance and candy and newspapers, what of it?
Totally. He's basically playing 3D chess while everyone else is still figuring out checkers. He talks about how this structure gives him the agility to jump on opportunities wherever they pop up.
So instead of being this massive ship that takes forever to turn, Berkshire is more like a nimble fleet.
Perfect analogy. They can explore different waters, capitalize on the winds without being bogged down by convention.
And that unconventional approach, as we've seen throughout this whole deep dive, it's paid off big time.
Big time is an understatement. It's a testament to his belief in his own vision, his willingness to chart a course that others might shy away from.
And he doesn't stop there. He uses this letter to kind of lay the groundwork for Berkshire's future, even hinting at the qualities he's looking for in a successor.
He's thinking long-term in every sense of the word. He's not just building a company, he's building a legacy, an institution.
And that's what I find so inspiring about Buffett. It's bigger than just balance sheets and stock prices.
It really is. It's about values, principles, a way of thinking that applies to so much more than just finance.
It's about thinking differently, having the guts to go against the grain, never stop learning.
It's about tuning out the noise, focusing on what truly matters, and building something that lasts.
And those are lessons we can all take to heart, whether we're managing a portfolio or just trying to navigate our own lives.
Absolutely. Buffett's given us the map, but it's up to each of us to take the journey.
So until next time, keep asking questions, keep exploring, and as always, keep diving deep.